Hi everybody, welcome back. In the previous video, we posted business transactions for the month of January 20XX for Craven's Consulting Service to a spreadsheet, and we found new balances at the end of January. In this video, we'll get ready to prepare 4 financial statements for Craven's Consulting Service. Please pause this video for a minute and turn to Chapter 1, Exhibit 1.10 in your textbook to see examples of financial statements for Fast Forward. You can trace the balances reported in these financial statements from the ending balances shown in the worksheet on Exhibit 1.9 a few pages back in your textbook. Notice that Exhibit 1.9 is quite similar to the worksheet we recreated for Craven's. Here's Exhibit 1.9 from your textbook. Very similar to the schedule we prepared for Craven's. However, in Craven's we did not find the balance after every transaction. We just waited and found the balance at the end of the month. So in preparing financial statements from financial data, the first financial statement we prepare is an income statement. An income statement shows the results of operations for a period of time. Was the company profitable, or did it have a net loss for the period? To calculate net income or net loss, we subtract total expenses from total revenue to calculate, in this example, net income. Next, after preparing the income statement, we will need to prepare a statement of retained earnings. The purpose of a statement of retained earnings is to show how retained earnings changed during the period. Do you remember from our first video lecture that equity is influenced and changed by the activities of a business? But there are 2 permanent equity accounts, common stock and retained earnings. Which one should be changed for the equity or for the activities of the business? Well, it's retained earnings. Retained earnings should be decreased by dividends and increased by revenue and decreased by expenses. Well, then why don't I see plus revenue minus expenses on this statement of retained earnings? Well, that's because that plus revenue minus expense calculation is already done on the income statement. Revenue minus expenses results in this example of $4,400 of net income. So by saying plus net income on our statement of retained earnings, we're doing the same thing as increasing retained earnings by revenue and decreasing it by expenses. So to prepare a statement of retained earnings, we need to record our beginning balance of retained earnings plus net income and get a subtotal less dividends to calculate our ending balance of retained earnings. After we're finished with our statement of retained earnings, the next financial statement we need to prepare is the balance sheet. The purpose of the balance sheet is to show the financial position of the company at the end of an accounting period. Do assets equal liabilities plus owner's equity at the end of the accounting period? In this exhibit 1.10 in your textbook, all assets are listed on the left side of the financial statement, and they total $40,400. Total assets $40,400. The liabilities and owner's equity are listed on the right side of the financial statement, and they also total $40,400. So the balance sheet is in balance. Total assets do equal total liabilities plus owner's equity. Let's take a couple of minutes to notice some very important things about the balance sheet. Notice that the ending balance of retained earnings is shown on the balance sheet. The ending balance is the calculated ending balance of retained earnings on the statement of retained earnings. Next, notice the dates shown on these financial statements. The income statement and the statement of retained earnings, and you'll see in a minute the statement of cash flows, are all expressed for a period of time, but not the balance sheet. The balance sheet shows those balances in assets, liabilities, and equity at the end of the accounting period, so the balance sheet is the only one of the 4 financial statements that is as of a specific date at the end of the accounting period. Finally, let's take a moment to discuss the statement of cash flows. We're only going to take an overview of this financial statement in Chapter 1. Then we won't prepare a statement of cash flows again until we get to the end of the semester. We'll cover statement of cash flows in depth when we get to Chapter 12. For now, however, you should know that the purpose of the statement of cash flows is to show the changes in cash from the beginning of the accounting period to the end of the accounting period, and that the statement is broken into 4 distinct parts. Cash flows from operating activities, cash flows from investing activities, cash flows from financing activities, and the calculation section. In this example, cash received from customers and cash paid for expenses are shown in the operating activities section. Cash paid for equipment is shown in the investing section. Cash received from issuing stock, also known as cash investments from shareholders, and cash paid for dividends are reported in the financing section. In the calculation section, the net increase to cash as a result of its operating, investing, and financing activities is added to the beginning balance of cash to calculate the ending balance in cash. Once you're finished with the statement of cash flows, it's important to compare the ending balance on the statement of cash flows with the cash balance shown on the balance sheet. In this case, the 2 numbers are the same. They should be the same. If they are different, it means that 1 or more errors are in your statement of cash flows and will need to be fixed before you're finished with the statement of cash flows. So that's the process of preparing financial statements. In our next video lecture, we'll use the ending balances on the worksheet we prepared for Craven's Consulting Services in video lecture 1.3, and we'll use the financial statement shown in Exhibit 110 in your textbook as an example of the proper format. See you next time.